morning, everybody. Hopefully you had a wonderful weekend and you're ready to hit it hard this week. So we have a very exciting call today with an idea that you probably have not heard about before that can make you lots of money. So well, first, before we do that, I'd like to just remind you, these 5-minute money makers, please pay attention to those. So the 5-minute money maker last week was, you may have some clients asking you about Bitcoin. So this goes through all the bubbles we've had throughout forever. And what are we finding with Bitcoin, guys? Reliable, not reliable? Yeah, not reliable, not reliable. So, and then we don't have the other one there, so I don't know what happened to our 5-minute tape review, but please be watching that too. And guys, what can we use the tape review for, that 5-minute tape review? What's a good use of that, if anybody knows? There you go, everybody. Jerry's got it, Nick's got it. Use that for ideas for doing your 15-minute drill, okay? Good. So we'll get on to the fun part of the call. So every once in a while, we have a technique that you haven't heard about before, or the vast majority of you haven't heard about before, or if you've heard about it, you've actually forgotten about it. And Jerry brought one to my attention, and he's actually closed. And maybe you can just give a couple of quick examples, not in detail, Jerry, but of guys that have actually used this successfully. So
yeah, thanks a lot, Mike. Yeah. So like you said, and I appreciate that, we're always looking for unique strategies that can help put you guys in a better position. So a lot of them come across our desk, and some are not so good and we ignore them, and some are very good. And an exact example, I had a case like this just recently where the guys we're going to be talking about here in a moment are going to get into depth with, where simply we had $1 million of earnings that a client had in an S corp, and they didn't want to have to pay a huge amount of taxes on that. So we were able to work with the group we're going to be talking about here, and they're able to get them around $400,000 or $500,000 tax deduction. Client was really happy, and agent got a nice sale on it. So they have a really unique strategy. So I'm excited to have Legacy Tree Foundation. We have the CEO, owner, and founder Jim Wolter on the line, and his associate John Frazier, and they're going to go over with you guys today how this strategy works from inside and out. And without further ado, Jim Wolter, you have the floor to go over this with the guys. So thank you for being on.
All right. Well, thank you, Jerry. We're really excited to be here. Thank you, Missy, Mike, all of you at 5Q as well. We're pretty excited to be able to share some ideas with you today. Some unique planning ideas. So again, thanks to everybody that's joining us. I believe you'll see that where these can be beneficial to some of your clientele, which in turn obviously is going to be beneficial to you and for your practice, which is the goal of this, I think. But let me just before we jump in too far, I'd like to knock these out so we can get this page behind us, the exciting stuff. Legacy Tree Foundation is our organization. We're a 501c3 public charity. It's important to note that we're not an insurance company, we're not a broker dealer, we're not a financial institution. We like to make sure we clear that. Number 4 there, we talk about planned giving transactions as outlined in the IRS code. So we're not talking about investments. They shouldn't be presented as investments. We don't give legal, tax, financial advice, which is, of course, why you folks are on the line, because you're the specialists at that. We don't give securities advice. And we're not available in every state, although we're in about 48 states. So we're probably going to hit about all of you on what we can do for you in our business. But of course, you'll assume by our name we are a charitable foundation, and so we're probably be a little bit more unique to you. We're actually a 501c3, just like many of the charities that you're familiar with, and I provide a little bit more detail about what we do in a few minutes. But we're different than most charities in that we raise our funds mainly by working with financial professionals, just like you folks, showing you how you can help your clientele take advantage of some simple charitable planning tools that are outlined in the IRS code. Needless to say, we'd probably be a unique addition to your practice. But today we're going to be discussing again how you can help clients take advantage of the benefits of charitable planning. Now, if you're pretty familiar with charitable planning already, you'll already understand this. But for me, back in the day, I'd been in the financial services business for 16 years before I became familiar with charitable planning. Sure, I knew how to make a donation to my church, just like you folks make a donation to the church or make a donation to Salvation Army or whatever. And I knew that you'd get an income tax deduction for doing that. But what we're going to talk about today is not about making straight donations to charities. Reason for that is you don't need us for that. Your client doesn't really need you for that either, because they already know how to do that. So we're not here to talk about that. Today we're going to talk about another type of donation or charitable planning where there's a partial donation. So we're providing a partial tax deduction, and then we're providing an income stream is also created. So it's not just the donation part; it's a combination of a donation and creating income, so that they get both of those factors: the tax deduction and the income for themselves and or for their heirs. Because in most of the cases that we do, actually, more income actually gets paid back to the client over time than the original value that they put in to fund their charitable transaction, in addition to those tax deductions that were created from that partial donation. So that's what we want to make sure that we're clear on, is we're not just talking about giving assets away. Now, because these programs are new to most of you, let's make sure that we solidify a couple of points here right at the outset. And one of those is that this type of charitable planning needs to be part of the services, I think, that you provide to your clientele. So we're going to talk about how and why, of course. And then also that you actually do have clients that can benefit this type of planning. You may not have given a lot of thought to that, but you do have some that will fit into that. And actually that kind of leads me to the thought that before we get too far along in the discussion here, there's a couple of thoughts as to why you may not have included this type of planning into your practice yet this far, because a lot of advisors tend to have some initial reactions or thoughts about charitable planning, and those thoughts might be incorrect. So I wanted to just touch on a couple of those. One of the thoughts that they might be thinking is that, well, this isn't charitable planning just for high net worth people. And so instead, I think what we should be thinking is, do I have clients who could benefit by reducing their taxes? You know, and really, who doesn't want to reduce their taxes? Of course, the 2018 tax changes are going to help most people get some reduction on their taxes, but it's not about the net worth of a client. It's about reducing their taxes. So for us and for you, it really comes down to, do you have clients who itemize their taxes? Because anybody that itemizes their taxes could be a prospect for this type of planning. It doesn't have to just be high net worth clients. So that's one thing. Another thought some advisors may have is that they're thinking, well, I don't have clients who are charitable or who want to give their assets away. But what we should be thinking is, which of my clients might be able to benefit by repositioning some of their current assets to create an income tax deduction or capital gain reduction and income for themselves or for their heirs. As I alluded to earlier, many of our cases are initiated because of looming tax issues involving some of their current assets. So it's not just the donating of the assets, but repositioning assets to meet tax and income and philanthropic goals of the clients. And then lastly, you might be thinking, well, I can't spend a lot of time, learning how to offer charitable options to my clients and not get paid for it. I need to run a business here. And of course, our model includes compensation to you. So, what I found is that so much of effective and suitable charitable planning revolves around retirement planning, tax and income planning, efficient transfer of assets to heirs, as well as the philanthropic and or the legacy planning, which is, most of those things you guys are already doing anyway. So we believe, of course, that you should be compensated for doing that. So our model has a 7% referral fee built into it, to provide a compensation to you guys for the work that you do in helping people do these plans, as well as help getting funds to do charitable work that probably never would have gotten there had you not introduced them to this type of a plan. Now, I know you'd all love to donate all of your time to your clients and do charitable planning only for them, but at some point you wouldn't be able to afford the gas to come and help them out. So that's why when we wanted to prepare our model, we wanted to make sure that there was compensation in there for you folks to do this. So you could put it alongside some of the other programs that you're showing your clientele. That's a couple of things why people haven't done it. Why should we do it? I think as an advisor, you want to consider this because a couple of things here. First of all, I think if you're the trusted advisor of your client, that client would want you to be versed in the most options as possible so that you can help them make informed decisions. I think it provides more credibility because whenever you have a complete and unique information for a client, usually increases the trust and the confidence of a client that they have in you as the advisor, which of course lends itself to the client being more loyal to you and confident in you. And then having more and diverse information, especially in the philanthropic area, also to me insinuates that you're maybe community minded or civically engaged, and I think that tends to give clients more confidence as well. And then lastly there, of course, if you're like most advisors, you don't want to be outdone by another advisor who might show up talking about these specific plans that are available to you, but someone else is talking about them to your client. So you just want to be up to speed on that. And these are things that you already know, and most of you probably have a solid client base. But if you're adding these tools, I think it just solidifies that a little bit more. So our goal here is, it's not to convince you that we should be the major part of your business. We know that we're a niche for what we do here. But in reality, this is a program I think that you need to have available, because there are certain situations where this might just be the best option for the client. And so that needs to be available for you in your practice. So we call our programs legacy plans. That's just our name for them, not too complicated. There are other charities, of course, probably call similar plans, whatever names they have. But the best description for what our legacy plan is basically just what the slide says there. It's a simple transfer of an asset to Legacy Tree Foundation. So they transfer an asset to us, could be securities, annuities, real estate, cash. Those are the main four. In exchange for that, there's a contract that shows them an immediate or deferred tax favored income for life or for a set number of years. And then again, because we're a 501c3, then there's going to be the income tax deduction, the capital gains reduction, and the estate tax reduction. And so it's really just as simple as that. And we'll talk about a couple of these assets here in a minute or two. But I want to review some of the general uses for some of the simple charitable planning that we offer. First of all, again, these are charitable plans. We are a charity, so we are getting money to help charitable causes in the end. Statistics show us that most high net worth households do charitable work at some level, and a high percentage of all households actually make annual charitable contributions. So most clients are involved with charitable planning at some point, or at least making charitable donations. And I mentioned this earlier, but a lot of people think of charitable planning as simply writing out a check to their charity and then getting the tax deduction. And that's good, but we want to reiterate that this is another level in the IRS code where they make the partial charitable transaction where, yes, they get the income tax deduction, but they also create the income. So let's talk about those two levels here, about the tax benefits and the income. On the tax benefits side, the first thing is that we basically, it's simple, we reduce current taxes. If you have clients who itemize their taxes, they can benefit from a tax deduction. It's really that simple. If they transfer a capital asset like securities or real estate, they get an income tax deduction, but they also reduce capital gains or eliminate a part of the capital gain. And then either all or a portion of the asset is always removed from their taxable estate. So we've got that aspect of the tax reduction as well. And I believe, we'd probably all agree that everybody likes to save money on taxes. So it's not just the high net worth, because lower net worth clients like that savings just as much. It's all kind of relative. Second point, there's a lot of people have applied this tax deduction in such a way that they're able to minimize taxes from Roth conversions that they may have done, or others may want to reduce taxes from RMDs. If they've had to take required minimum distributions, that would be a way that they could reduce taxes as well. And then we've also had conversations with people wanting to be able to make qualified distributions potentially tax-free as well. And so that's a fun conversation that we'd like to have also. Because with the lower new tax brackets, it's a good time to be able to access qualified accounts more tax efficiently than they could before. See, the way that works, just real briefly, is that when a person creates a new tax deduction through one of our charitable plans, they can pull money out of their qualified account and then apply the new tax deduction to offset that taxable income, making the qualified distribution tax-free. And then that works very nice for clients. And they may even use that tax-free money that they got out of the qualified account to purchase life insurance so that they can get the value of that asset to the kids way more efficiently. And then lastly, point there, the tax deduction can also move someone's reportable income to a lower tax bracket. Of course, we know with 2018, we've got lower tax brackets, so they're going to save some money, which will help with that. But then the tax deduction can reduce it even more. And of course, creating a new deduction moves people to a lower capital gain bracket as well, because now we have capital gain brackets, and so people can save money on that area too by doing a program like this that creates tax reduction or creates tax deductions. But the thing to think about for you is that we all have clients who probably think they're paying too much in taxes. It's kind of relative what they are paying. A lot of people think they're paying too much, and if we have a solution for that, then this is a great conversation starter for them and potentially a great solution for them. The other component then is on the income side. And of course, as we said, they're getting the tax benefits like we're all familiar with. But with this type of plan, they're also creating the income. And as I mentioned, over time, most people will actually get back more than they transferred to the charitable plan, in addition to those tax benefits. So the income can be immediate, can be deferred, can be for life, can be a term of years. Of course, the income can be for themselves. A lot of people like to set up a structured inheritance for their heirs. They find that they have assets that they're probably not going to use. This is a great way for mom and dad to get tax benefits now and then have an income go to their heirs, leaving it as a legacy for the kids. And then lastly, as I alluded to, one of the great tools is to use the income or a portion of it maybe to fund life insurance premiums to replace the asset value to the kids. A lot of times they can use the income from these plans to purchase a life insurance contract that gives them actually a larger value, a lot larger value in some cases, going to the kids via that life insurance plan, and probably it's going to be tax-free as well. So you all know how that works, and that's a great solution with this type of planning. We basically have two programs. Whoops, I'm a slide ahead here. Let me just show you how it works here first. This is just a flow chart of the transaction, what actually happens, assuming we've had some case study, done some case design, determine it's suitable, determine it's beneficial, and we're going to move forward. Here's the process of what actually happens. First of all, the client transfers the asset. They just basically sign over ownership of the asset over to the charity, and then the charity issues a contract in return. It's pretty simple. That contract is going to talk about the income tax deduction, the capital gain reduction, estate reduction, and the terms of the income, whether it's immediate, whether it's deferred, term certain, or lifetime. It's really that simple. Now, the other thing that we do is, because we are promising that income is coming to the client then from Legacy Tree Foundation, and a lot of times it's a pretty long term that could be paid out, could be deferred for 5 years and paid for 20. So we've got a long term that we're counting on for that income to go there. So you guys, your clients, us, we all need to be confident that that money's going to be there. And so for that future income stream. So in our case, instead of investing those reserves into something potentially volatile, we simply invest in an annuity contract from a highly rated and familiar insurance company. It's our reserve method. Sometimes we call it reinsurance, but in essence, what we're doing is we're insuring that future income to that client. And then when the time comes for the income to begin, we usually have the payments go directly from the insurance company right to the client on our behalf. And again, that tends to increase the comfort level for a lot of clients as well. And then, of course, the reason that any of the charitable benefits are available is because it is a charitable plan. So we allow the client then to recommend a charity or charities that they would like to see benefit from a portion of that charitable component of the transaction. So they get to participate in that charitable component. And so that gives them a little more involvement and control and flexibility with the program as well. So we have two plans that we talk about, just to summarize. They're both called legacy plans. One is just a term certain payout. One is a lifetime payout. I'm sure you can assess what that means there on the left side. This is what we do probably about 98% of the time. And that's where we pay the income on a term certain basis. And the IRS code, that's known as a charitable bargain sale, fairly common tool. But we actually attach that to an installment contract so that it can be paid back over a term of years. And you can see the codes listed there. On the right side, that's a charitable gift annuity. Some of you are familiar with that. And they've been around since 1843, so they're not a new concept. And that's just a charitable plan that allows income to be paid to one or two individuals for a lifetime. And so that's basically how they work. Again, they kind of work a little bit like they do in your world if you're just doing annuity business, for example, because you do the suitability, make sure it's beneficial and right for your client. And if they're going to do an annuity with one of your regular carriers, you fill out the app, you collect the check, you send it to the insurance company. Well, it's going to work a lot the same way, except that we're not an insurance company, we're a charity. And so we can fund our program with assets other than cash, which we've alluded to. And because we're a charity, then they have the tax benefits included as well. And so that kind of sums it up. And the other thing, let me point out one other thing here, is these are not a trust. I know most of you are probably familiar with the charitable remainder trust. So these are going to work like that because it is a charitable program, but they're not going to be as complicated as a trust. And you can use smaller assets to do these types of programs. Trusts, can be cumbersome. They can be complicated, expensive to set up and maintain. I'm not trying to diss the trust because they're a great planning tool, of course. But these two programs, they don't have the setup fees. There's no ongoing tax filings. There's not volatility of assets in the trust. They're just simply a transaction, as I just alluded to, where the client exchanges the asset for the contract from Legacy Tree Foundation. Had a guy in Colorado once, he said, well, it's kind of like a CRT light. And actually that is true because you're getting a lot of the same types of benefits and outcomes. You just don't have to go through all the legwork to get there. So I mentioned the 4 popular assets that we use to fund these plans, and we talked a little bit about how and why. So I want to get a little more urgent as to which clients and which assets we might want to consider for this type of planning. So I'm just going to touch on a few things with the 4 assets mentioned above that we might want to talk about, because a lot of the charitable plans that we do are executed because of potential looming problems with some of your clients' existing assets. As we know, most assets perform as expected during those accumulation years, but there comes a time then during the income and distribution years, or at the time that they want to pass the assets to the heirs, that the assets can be more of a problematic situation at that point because of some tax issues. So we won't spend a ton of time on this, but I just want to give you a kind of maybe a refresher as to why these can be good for certain clients. If you have cash type of clients, then who do you want to consider? Firstly, those that are paying too much in taxes. And as we mentioned, who doesn't think they're paying too much in taxes? So if you have discussions with your clients about tax reduction, they might want to know about these ideas, because most of us have clients with what we call that lazy money or funds in CDs or in money market accounts that are not gaining a whole lot. And then what they are gaining are tax deductible, or are taxable. So these can be the perfect type of a transaction to offset some of those and maybe give them more potential on the income side. Thinking of clients who may have sold, think of clients who sold real estate or a business or cashed in qualified account, and now they have a tax issue to deal with. So transferring cash to create a deduction is a sound year-end decision for those types of folks. Again, creating the tax deduction to offset taxes on non-qualified assets is great, but if people are having qualified assets like RMDs where they have to take them out, then the taxable issues on those would be a nice thing to be able to resolve for the client. And then helping charity. A lot of folks want to help charity again, but they don't want to give the asset away, so this can be a way to do that. Regarding heirs, we've done several cases where mom and dad didn't want kids to inherit a lump sum or maybe even annuity where they could just cash it out. So these programs work nicely to lock in a structured payout to the heirs while benefiting from the tax and philanthropic benefits now. A lot of folks don't want the kids to get that lump, so this is a great way to set up something structured. We like the term structured inheritance there. And then, of course, if you got, this is a great one to consider, actually, regarding high net worth folks, because if you have high net worth clients, a lot of those folks put enough into the retirement plans where they're maxed out and they can't fund them anymore. And so this is a great way for those high net worth folks to maybe provide a secondary retirement plan, because they can put money into a legacy plan. It gives them tax deductions now, but then they could have an income to start at some point in the future. And there's a lot of wins in that scenario also. Securities is another one of the great types of asset transfers because of the 2 benefits. They get the income tax deduction as well as the reduction in the capital gain tax. So securities is a great asset to consider when you're thinking about this type of planning. And really, who is it? Those that want to reduce exposure to the market. There's people probably as they get to be a little bit older, maybe want to be out of the market or maybe should be out of the market, or want to just get off that roller coaster. This would be a great plan to help them to do that, because a lot of seniors now, a lot of folks in general, but especially seniors, are happy again where they are and some of the growth in their riskier types of assets. But now, the market's a little volatile as always. If there's a correction, they might not have enough time to recover. So a lot of these folks that are happy might want to get out, but they don't because of the capital gain taxes. And so this could be an excellent solution for them to be able to do that. And of course, with the income tax deduction, it not only reduces capital gains, but also their income taxes. And then it works great again for folks that want to get out, reduce capital gains, create the income tax deduction, and then use the value of the income to purchase life insurance to get that asset value to the kids more tax efficiently. So these are great assets to consider. Now, just as a quick disclaimer, we're not a broker-dealer financial institution, so we're not going to give securities advice. You have to make sure you're properly licensed if you do give securities advice. Real estate's another asset that a lot of times gets left on the table. I know a lot of financial people just don't get involved with the real estate side. They're like, well, Mr. and Mrs. Klein, when you sell the real estate, let me know, when that's done, and then I can help you with the net value that you have after the fact. Well, if you can be involved on the front side of that, you can be very helpful and be quite a hero to them if you can help them offset some of the capital gains on the front side, create income tax deductions as well as income by doing one of those transactions. So that's a great asset that we want to talk about there. The real problem with real estate is if you have folks with rental properties, second homes, those kind of things, the kids anymore don't live near where the folks do in a lot of cases. And so it's kind of a hassle for the kids to have to come back and deal with it. So if you can do a real estate case where we can liquidate the asset, create the income, get the tax benefits, and then maybe use that income for life insurance, that's a case where the kids go gaga over that. I mean, because they don't have to be involved in the real estate, and they're probably going to get more money than they would have had they just inherited the real estate through that life insurance contract. So that's a great asset to consider as well. And then I want to talk about, this is our most popular asset type. I want to talk about annuities a little bit in terms of how this can work with charitable planning. As just mentioned, annuities they're typically our most popular strategy for transfer, and that's because, of course, annuities can be a wise planning tool. All of you know that. A lot of you probably do a ton of business. That's why there's something like 2 trillion plus of annuities in force today. So we know how valuable annuities can be for income tax deferral, retirement planning, income planning, all those things. But the point is if you have a happy client, you're probably in a nice position to talk about the future of their annuity and what they're going to do with that, because currently less than 5% of folks actually annuitize their annuities, and so it seems most of those are going to be planning on passing those on to their kids. What does that mean? You all know the answer. The kids are inheriting the gains or the growth in those annuities, which are taxable. So annuities aren't necessarily the best asset to be used to transfer wealth. They're good for accumulating tax deferral, but maybe not the transfer of wealth. So, of course, mom and dad are going to be concerned about passing tax situations onto the kids through those annuities. And so a legacy plan that's funded with an existing annuity might just very well be a more suitable and beneficial way to get the asset value of that annuity to the kids more tax efficiently. Of course, the income tax deduction can offset the gains in an annuity, but it can also reduce their tax bill as well. So that's where that's important as well. And then it's also great for setting up that structured inheritance to go to the kids as well, instead of getting an annuity, cashing it out, having to pay taxes, and then spending the lump sum. This is a great way to set up, again, that structured inheritance, maybe for just this portion of an estate. I actually want to think about your clients. I've added an extra slide on this one because I want to make sure that we have a couple of thoughts as to how we can maybe introduce a concept to the client. I don't mean to insult any of your expertise, but maybe it'll save you from having to come up with some of these thoughts on your own regarding how you might initiate that conversation. Just quick questions, Mr. and Ms. Client. Do you think you'll access income from your annuities? If you're already their advisor, you probably already know the answer to that. And most of them won't access that because, again, less than 5% annuitize their annuities. A lot of people might take some income from it, but they don't turn them on in terms of annuitization, which leads to the question, are you concerned about passing tax consequences to the heirs? And I think we all know the answer to that. Most of them are concerned about that. So would you like to create a structured inheritance for your heirs instead of giving them a lump sum? Might be another question. And then, of course, could you use a tax deduction now, still like to have income available for yourselves or for your heirs at some point in the future? So those are some kind of initial questions that might be helpful. Since this is one of our popular subjects, I'm going to give you a quick case design so you can kind of, or a case study here, so you can see a little bit of how this might work in a situation that might be similar to one of your clients. Rob and Irma Carter purchased an annuity several years ago for $100,000. Their initial goal was to put money into something that's tax deferred and has potential for growth. It's now worth $150,000 with a surrender value of $140,000. So that's a pretty common situation there. They got $50,000 a gain in that annuity. Now, they don't believe they'll use this annuity, but they are concerned when their children inherit the annuity, they may have to pay taxes on the internal growth. So that's the issue for these folks here. So what did we do? This is going to be the chart just like we showed with the flow chart. They transferred their $150,000 annuity to Legacy Tree Foundation in exchange for that legacy plan contract. So we're going to issue that legacy plan contract at the $150,000 value, even though it's still in its surrender period. And that's because that's the value the IRS is going to recognize. So even though we're actually getting the surrender value, the tax deduction can be based on the accumulation value. That's going to look a little better on the tax deduction. So then a number of factors on our end go into the case design to determine the amount of the income that they're going to end up receiving, the terms of the payments, if it's going to be deferred. We have to consider the surrender value. We have to consider the income versus the charitable component and the cost of the reinsurance. And we'll discuss those things when we do case design conversations with you or when you talk to John Frazier here at the office. But in the end, the contract determines the benefit that they get in return for their asset. So let's talk about that. So in this case, they were able to create a $71,302 income tax deduction. At that new 22% bracket, that could put $15,686 right back into their pocket. So here's the thing. What we're able to do here is to use this new tax deduction to offset that $50,000 of taxable gain, that deferred growth that they've collected. It allows them to settle up with Uncle Sam now so that the kids don't inherit this annuity with that lump sum tax attached to it. And then if the deduction is large enough, it could also reduce the regular current tax liability, depending on what their income is and what that deduction is. So the main thing is we're able to offset that $50,000 a gain, and then we still have tax deduction available to further reduce their taxes. Again, we're not tax professionals here, so we're not going to give you tax advice. So make sure your client situation is verified with tax professionals. But this is a great solution in terms of the tax side for offsetting the gain in that. Then on the other side is the income side. In this case, in 5 years, the Carters or their heirs are going to get $82.20 a year for 20 years. And again, for most of the cases we do, the parents weren't planning on taking the income from their annuity, but they still have the ability to access that income while they're alive if they would like to, or they can name their children as beneficiaries to receive that term certain income in the future. And this is nice, again, because a lot of parents, as mentioned, would like to set up that structured inheritance for the kids for this portion of their estate rather than having them receive everything in a lump sum. And then again, on the reinsurance side, we're committing for several years, so we simply invest into an annuity contract from a highly rated and familiar insurance carrier to ensure that future income. So the income and the tax benefits in this case is 180 plus that they're going to benefit from it. And that doesn't even consider, I throw this out on the side because if they were to actually reinvest the savings on the income, that would add some additional economic value to this case. So here's the thing you want to consider, why we want to consider this type of program with your clientele, because one, you probably have some clients who are never going to access their annuity income. Secondly, those same clients would like to avoid passing a taxable event on to their children. And thirdly, they would also just in general like to reduce their taxes this year. And maybe even the following years, depending on if they can carry that forward. So think about which of your clients might be able to benefit from a scenario like this. And again, that's what John Frazier's here at the office is to communicate and go through case design about those specific cases and if or how they might be beneficial and suitable for your clientele. So what's in it for you? A lot of times advisors, as mentioned at the outset, that haven't done this type of planning because of the compensation issue. So we're set up to provide a 7% referral fee to you as the advisor. It could vary depending on your state, but it's a referral fee that we've built into our model. Two other considerations there. One is that the contracts can be issued at any age. So that's key to consider because you all know how that works. As you have clients get a little older, your limitations expand. And then we provide the same comp for all the ages too. So that's huge as well because as in most of your other stuff, as clients get older, your compensation diminishes. Not the case here. We don't have any reason to reduce that. Secondly, the reserve method and how we insure these is a benefit to you because it's a benefit to the client and it's a benefit to us. We all sleep more comfortably knowing that 100% of the present value of that future income payment is reserved into a fixed annuity contract. So we know that that's secured by highly rated insurance carriers and their claims paying ability. So we're real confident in that. And that's something that we've done since day one. Every contract we have has a standalone investment into an annuity contract to ensure that future income. And then lastly, it's a benefit to you because, again, it's a benefit to the client in providing flexibility and control to the client because we let them participate in the charitable component of these transactions. See, a lot of times when you introduce the concept, you might talk about the taxable benefits, maybe the income benefits. When a client understands that there's benefits like that available because of the it's a charitable program. Then they want to know about the charitable component. So we let them participate in that charitable component by recommending charities they'd like to see benefit. Legacy Tree Foundation, again, is a 501c3. We've been around since 1999, so we've got about 19 years of existence now. Obviously, we have to do charitable things to remain tax exempt. So, I think the IRS code was originally designed to encourage charitable work. Most of us would probably agree that charities are more efficient than the government at doing charitable work. When we have these disasters, you usually find that 80% of the help comes from charities versus government programs. So, that's why they've allowed for the tax deductions to be available. So our mission is we're a Christian faith-based charity. Our mission is provide spiritual, physical, and humanitarian aid to those in need. That's what we actually do as a charity. And so, but clients again can recommend. We have 6 charities that we support, but then clients make recommendations, and so we've provided grants to hundreds of different charities around the country, all the way from colleges to animal shelters to teen pregnancy centers, obviously churches, colleges, hospitals, those kind of things. Wounded Warrior, St. Jude's, Shriners, those things that you've all heard of as well. And so that's what we do and who we are as a charity. But really, in the end, I think it comes down to who are the primary beneficiaries of your client's nest egg. We call this involuntary philanthropy, where the U.S. government is the main beneficiary, albeit maybe the uninvited beneficiary. And so the way that plays down the screen there is kind of the opposite of what we want to have. We don't want the IRS to be the first beneficiary and then family and charity. I think what we would all like to see is that the family becomes the first option of where money would go, and then charity, and then the IRS. And so that's what we're trying to accomplish doing these types of plans. And so a couple of points I'll make in summary, and then if we have questions, we can cover those. But bottom line is, I think you have clients who would like to reduce their tax bill. Some have to take RMDs. Some may have done or might be considering Roth conversions. Some have sold assets with tax issues. So charitable programs can be structured to help in these areas. You probably have clients that have appreciated securities they'd like to exit from, especially if they're seniors, but they hesitate because of the capital gain issues. These programs are a nice way to exit more tax efficiently. If you have real estate clients that are sitting on real estate that they don't liquidate, it's a great time to move real estate now because the market's high, which means they probably have more gains to deal with. So these make great transactions for that. And of course, you all have annuity clients who plan to pass their annuities and those internal tax issues onto their heirs. So a lot of people have done a suitable plan with us to offset some of those annuity gains that the kids stand to inherit. And the truth is, and I've alluded to it earlier, is it may be more suitable for them to do our legacy plan program than to simply pass the taxable annuity onto their heirs. So that's something to consider. A lot of clients want to set up that structured income where they can set up a structured inheritance. We've had some cases done solely for that reason. They wanted to lock in a structured inheritance for the heirs so that they couldn't blow a lump sum. If you're an advisor, and I think most of you are probably advisors who do estate and tax and trust planning for your clients, then you're aware of you have a little closer handle on your clients' non-cash assets, may have a handle on knowing whether it would be advantageous for them to reposition some of these to create the tax advantages. And then if you're looking for a way to be able to increase your production without having to add new clients, you might also want to consider these programs. And the reason for that is because most of the cases that we do are done with current clients. Most of the cases are done with your current clients using their existing assets. So they're assets that many times are just simply left on the table. So it's a way to increase business because you're talking to your same clients about assets that they're not doing anything with at this point in time. So, bottom line is this really just simply a way to keep the IRS from being a major beneficiary part of your client's nest egg. I think when we can resolve the issue of passing taxes to the children and providing the additional tax savings, it's a popular discussion with your clientele and could certainly be a new reason to communicate with them because there really aren't that many options that you have where you can get this much tax advantage and the income, all while helping those in need. So that's all I wanted to present at this point in time. If you guys want to,
I had a couple of questions on exactly how the charity benefits, how much of the money goes there, or just more information so that they would feel comfortable with that part of the program.
Yeah, that's a great question, and I promise we didn't rehearse this in advance, but I have one slide that I just happened to, when I was setting up the presentation, I thought, you know what, I think I'll just leave this slide on the end, because normally I just leave this up while we ask questions, but I do have a slide right here that actually I think works real nice to answer this question. Ironically, that was the first question asked. And so, yeah, the question is, how do we benefit? Just how does I like to just say, where's all the money go? So how does it play out? So if we have to do 100, let's just assume 100% or $100,000 transaction, this is what happens. First of all, the big blue side there, we're going to insure that future income. We spend 75 to 80% of the money that comes in goes to insure the future income. Now, these all have a little, a little window there of space, because part of that is determined by if the client would like a little more to go to charity. That means they're going to have a little less go to income, and therefore we would spend less on the reinsurance. But usually we like to present the initial illustrations where all the money comes back and more. And so it usually takes us somewhere in that 75 to 80% range of the money that comes in to ensure that future income stream. Then we have some compensation built in there for advisors and marketing fees. And then the grants that we offer to the client or the donor to be able to participate in range from 5 to 10%. And that's a question that's I like to touch on a little bit longer, because people think, well, you got 100,000 in, you're only going to put 5,000 to the charities. They get to participate in that. Well, the key is they could have it all go to charity if they just wrote a check out to the charity. If that's a situation, then more of it can go to charity based on less income. And so in our case, because most clients want more income, then that's why that percentage is what it is. So we have a range of usually between 5 and 10% of what goes to their participation in the charitable component. And then on the operation side, that's just what we have available to operate our organization, pay us to be here, pay our rent, and then do the charitable work that we do as well comes out of that operation portion as well. So
I'm going to jump in there a second.
Yep.
So guys, you get that if your client is really charitably minded, they can give all 100% of that to the charity, and then they get zero income. So this is not designed specifically for the charity. It's designed for somebody who wants income and is charitably minded and wants to reduce their taxes. So if you find somebody who just wants, the box at the how much is going to the charity, you say, oh, that's easily fixed. Let's just give it all to the charity, and then you get no income. And then how many clients at that point are going to say, oh, yeah, that's a good plan? So let me see some answers to that.
Good. You've summed it up very nicely. And that is the answer. It's a balance there, and that's a seesaw that we work out to. Most of the time, though, you're talking initially about the tax benefits, and so that's where that comes in. And it's like estate planning attorneys. When they do trusts. The reason that they're setting up the trust in most cases is to protect shelter funds, and to protect them for taxes. So this kind of is a similar.
We got a lot of questions here. I'm going to jump in, okay, so we don't run out of time.
Yep.
Sorry. So how does your income pay out compared to a commercial SPIA?
If they're looking for doing a transaction, this can kind of be the reverse of what you just said regarding the charitable component. If they're looking for the most income, you're better doing a SPIA because of the charitable component in here. The basic number that we start from to begin paying income is going to be a reduced number because of the charitable component. So what we have to balance
with the tax benefits.
Well, that's what I was going to say. So what we have to do is we have to balance the income combined with the tax benefits to determine the economic value of it. And so if they're just looking for the most income, you're going to want to do a SPIA if that's the number one thing. If you got tax issues with some of the assets that we talked about, we want to create income to get them back more income than the value of the asset over time with the tax benefits, that they can use today, then that's where this fits nicely. And so that's what we do case design for, is to determine that.
Perfect. And what's the turnaround for bringing a client to you and getting this all set up?
Quickly, generally, it really comes down to the what the advisor has in control over the client, or how well they work with the client, number one. But depending on the asset, a cash transaction, if you call us today and say, I want to talk about this client because they want to reduce their taxes and we're going to send you a check next week, we would have that. The case would be closed in probably 10 days. When we get the check in, depending on how the check comes, we have to make sure it's cleared, and then we prepare the contract and that goes out, and that can happen in probably 10 days where we issue the contract back as well as compensate the advisor. If it's annuity one, that's the one that we do most cases are annuities that we do, ironically, but that takes a little longer because it all depends on how quickly the insurance company participates with the requests that we've made. Because number one, we have to change the ownership. So when you're talking to the client and you can say, yep, we're going to do it, we fill out the legacy tree application and we fill out a form from the insurance company saying change the ownership to legacy tree. You send that to us, overnight it to us. We fax it to the insurance company the same day. There's a couple of companies that'll change that ownership in 1 or 2 days. I know there's one company that'll take 30 days to do it. And so it all depends on how quickly they change ownership. Once they change the ownership, we just determine what we're going to do with that annuity and how it's going to work out, if we have to cash it out or whatever. And then that all comes back on the insurance company too, if they send us a check right away or not. But so those can take anywhere from maybe 10 days to, a month on annuity transfers.
So it's based a lot of that on the people who are giving you, how the money comes to you.
Yes, real estate depends on if we can liquidate the property. Those just we have to have the real estate price right. So,
okay. So here's another question: if you use a non-qualified annuity, does the client have to take income at some point, or can he or she hold a deferred annuity in perpetuity and then pass the assets on to their children?
Either. So they can start income immediately. They can defer it. We do a lot of cases, more than not, where the client's intention is not to take income. And so we set them up maybe on a 5 or a 10-year initial deferral. And we have a lot of them this year, they're coming up. It's 5 years now down the road. Their income is supposed to start, April 1st. So do they want the income to start? We call them, speak to them about that. And then they say, well, no, I intended that to go to my heirs. So then we recalculate another, deferral period. Obviously, if they defer it longer, the income when it does pay is going to be larger. They can also reverse it too if there's like, well, life changed, or maybe they're mad at their kids now and they want to start receiving the income so they can take more vacations. Then we can move that income up also. Of course, it's going to pay a little less income if they take it in the 3rd year of a 5-year deferral. But yeah, there's flexibility to take it earlier, later. A lot of them want to have it happen when they pass away and have it go to the kids at that point. Cool. And then the kids would even have flexibility at that point too, to maybe potentially take a lump sum unless mom and dad specifically didn't want that to happen.
Okay. And what is the minimum investment? And then there's an actual question: is a $50,000 stock portfolio with big capital gains too small?
The second question is no, that's not too small. It changed this year a little bit because of the new tax laws. And the reason is because now they've increased the standard deduction, as you all know, because last year it was like 6,300, I think, for a single and 12 something for a family. This year it went to 12,000 individual, 24 family. So it means if somebody's making $50,000 a year, before they do anything, they've got, if it's a husband and wife, they've got a $24,000 deduction with that standard deduction. And so we need to, in that case, create a deduction that's going to be larger than 24,000, unless, of course, they've got other deductions. Because if they're not going to itemize, there's really no tax value in our program. If we create a $23,000 tax deduction for them and they don't itemize, it really didn't do them any good because they could already deduct 24 with that standard deduction. So a $50,000 case typically is going to be about it's going to be probably close to a $20,000 to $25,000 income tax deduction. But on that case, of course, you've got capital gain reduction too. So that solidifies the suitability of it in terms of that aspect of it. So that's not too small, but that is about borderline. Usually, maybe somewhere 30 to 50 is going to be borderline being too small. So, that's something we'll talk about with case design.
It depends on where their other income and how much of that they have coming in deductions. And then the income that they're getting, how is that treated for tax purposes?
Oh, good question. Well, you guys got some good questioners there. I appreciate that. The transaction is going to be either 2-tiered or 3-tiered in terms of how the income, it's going to have similar to an exclusion ratio kind of a thing. If they transfer a cash type of asset like annuities or annuities or cash, then there's going to be an initial present value from day one. So the program is done with a charitable bargain sale. And just try to real briefly tell you what a charitable bargain sale is. A charitable bargain sale is a transaction that charities do where a client, in essence, sells the asset to the charity for less than the fair market value. So if it's $100,000 asset, for example, the charity may buy that for $60,000. Let's just say in our case, we buy that asset for $60,000. That means they're getting a $40,000 income tax deduction. a charitable bargain sale, the charity gives them a check for $60,000, end of transaction. They got a $40,000 deduction, a $60,000 check, end of the story. In our case, though, we have the installment contract on the back end of that to pay a term certain income, and so the $60,000 is basically the principal of that future income, and so we're going to pay principal and interest over, say, a 20-year period, but because we did get $100,000, we can inflate that interest rate, and so it's going to be something like 5.25, 5.3, somewhere in there, so that over a 20-year period they get back well over $100,000. And so the taxable portion of that is the bargain sale value is going to be tax-free, and then there's going to be growth on that money through the years as we pay income, so a part of that's going to be taxable, and then that would be how that would work. If it's a capital asset like securities or real estate, then it's going to be three-tiered. There would be a return of principal, which would be tax-free. Part of the capital gains gets totally eliminated, and so part of the capital gains that comes, part of the income that comes back would be capital gains, so that would be treated as that, and then the other portion would be interest for the growth on the money through the years, the growth of what hasn't been paid. So that would be that.
So the simple answer is it's tax favored, and depending on how the money comes to you would depend on how tax favored.
Exactly.
Okay, and then yes, they're going to give us a phone number for you guys to talk about specific situations here at the end. I got another question here, so I'm kind of rifling through these quickly so we get done here at the top of the hour.
Yep.
$1 million IRA wants to eliminate RMDs. So it'll work for something like that.
When we do qualified, the start of a qualified discussion is we can't take the qualified money directly. In other words, there is the one rule where you can donate up to $100,000 if you're past 70.5. I think it is. You can donate an IRA to a charity directly and just give it to them. But we're not talking about just giving the asset to charities in this discussion. If they want to do that, we could do that. The question is, how can they offset some of the taxes on that? So what we have to do, because we can't take ownership of the qualified account, we have to find money in a non-qualified account to create a legacy plan that creates a tax deduction. So if it's $1 million, that'd be a challenge. We can offset some of it. There's two things they can do. One, they can cash part of it in. That's going to be all taxable. Say they just pull out $100,000. Okay, now they got $100,000 increase of income. Maybe save back $15,000 for taxes, transfer $85,000 to Legacy Tree Foundation, and that creates, say, a $55,000 tax deduction to offset the rest of the gain. So instead of paying maybe 30% in taxes, maybe they're going to pay 15% in taxes because they kept out that $15,000 and used the tax deduction to offset the rest. I should have had one more slide here that I could have kept on board. But the real thing is, in summary, they have to use a non-qualified asset to create the income tax deduction, and then based on what that income tax deduction is, determine how much of the RMDs or how much of a qualified account that they could pull out and use the tax deduction to directly offset that taxable event. That's kind of the short answer.
Okay, and then for non-qualified annuities, can they do partial transfers, or does that generally have to be the whole annuity?
Yeah, I don't think you can change partial ownership on an annuity.
No, you can't. So there's the answer there. So I'm going to just stop there. And then, guys, I've got several questions. Yeah, go ahead.
I was just going to say one quick thing is we do have a lot of cases where people will transfer an annuity to us, the whole annuity, and then we will refund part of the cash back if they want to go that route, and we can do that too. So it wouldn't be exactly what you're saying, but maybe they want to have 50. They don't want to do 50%. Well, we could give them 50% of the money back potentially, come back as cash, and then set up their legacy plan based on that.
Okay, and guys, I got several questions about how do we approach CPAs. Don't, guys. This is for people that that you run across, because what you're looking for is somebody else to find your clients for you. You're not going to find a CPA that's going to be running around referring a whole bunch of people to you. I'm just telling you. There's all sorts of great things, premium financing, this and everything else. This is for when you run across clients that are looking for help. Don't spend, now if you have a CPA as a good friend, very close to you, go ahead and do this, but don't think this is some sort of new marketing thing that you can go out and look for CPAs to do this and you want to get in front of them. It ain't going to work. Get your hiney and get your mind right and get into thinking, who do I know? What kind of people do I know that this could benefit? That's where the cases come from, not from you thinking a CPA is going to refer you a ton of freaking business, because they're not going to. So please quit thinking about that. And then, yes, you obviously have points of sale, and you're more than happy to talk to any of these guys.
Yeah, absolutely.
Right? Yeah, good. So do you have a phone number and all that kind of stuff that they can call?
Yep. Let me go back this slide there. That's got the phone number and the website on there again. But your in-house connection is going to be John Frazier. He's one of our in-house advisors, and he's going to have his phone number is going to be that phone number. His extension is 7015. So it's the phone number on the screen, 7015, and then his email is going to be that finish of our address there, but it's just J Frazier, JFRAZIER at legacytreefoundation.org. So you got the last.
If you have any questions, you can. Okay, and if you have any questions, you always get a hold of Jerry or Matt, and they can get you hooked up as well. So I want to. Yeah, go ahead, Missy.
Our contacts. Yep. I'm sorry, I'm posting this information underneath our contacts, underneath the resources. They're actually already listed there. If you scroll down to the L's, you'll see the Legacy Tree Foundation with John's information, his email, and his phone number.
Super. John, thank you so much for the help. And Jerry, could you just get in there just one for very briefly talk about like an example of a case that one of our guys have done?
Yeah, thanks, Mike. So some of the other, like John was saying, sometimes if they just want that highest income, like you said, the SPIA would be the best way to go with, but there is a total economic value. So one of those instances where that SPIA wouldn't have been a better case for this client. If you have like a client that had a bunch of real estate or they sold a business, there's no way they could defer all of those gains that were in there, or if they had a bunch of earnings from their business. So just an example of a case that we did recently, and just to point out, these are really easy to do. I had John and Mr. Wolters come on and explain this to a rep a week prior, and then we had $1 million case sold with this because the client had $1 million in earnings from their business. So that's one way where it could make a ton of sense right there. And he had this $1 million of earnings, and the clock was ticking for the new year. So if they wouldn't have had a solution for this, they would have paid, somewhere in the $400,000 range in taxes on that $1 million. So it was really easy. We did the charitable bargain version that he was talking about there, and the client ended up getting around a $500,000 deduction and saved, in the $300,000 range in taxes. I think they only ended up having, there was a smaller amount there, and then it set up an income. We did a 10-year deferral, and they're paying it out over 15 years. So that was a case where they would have gotten a lot. They ended up getting a lot more income. They wanted some sort of retirement type of a benefit because they had $1 million here. They couldn't put it in, all of it in a 401k. There's limitations on SEPs. So this was the ideal way for them to take this $1 million, get a huge tax deduction, and then actually set up an income for themselves down the road. And there was literally no better way for them to do that than using this. And to point out too as well, the thing that was so nice about it is John and Mr. Wolters, they'll go over the case with you. The design is fairly easy to understand, easy enough for this guy the first time he heard about it to have a large case like this with a client sold within a week. And the client got a nice income stream down the road and a huge tax deduction, as much as $500,000. I think they ended up, the actual value of tax money they saved was around $250,000. So that's a case. If simply if people have earnings, maybe they sell real estate. I have people come up and talk to us about this, or maybe even sell a business where there's no way to defer the taxation on that for down the road. Here is the way. The next best thing is getting a tax deduction, and that was for someone that was like 38. I think it was a 38-year-old and a 45-year-old. So
guys, this is something for when you run across. This is terrific, and I don't mean to beat up on you about approaching CPAs, but as soon as you go into this, first of all, now's not the right time of the tax season. Second of all, if you go present this to a CPA, they don't trust you anyway. So unless the guy's a friend, you already have a relationship, yeah, absolutely to let those guys know. But don't think you're going to go to CPAs cold and get them all excited about this, because they think you're just trying to take advantage of the clients. You already need a relationship with a CPA who already knows you, already trusts you, then absolutely show them this. But you're not going to go to a cold CPA and get them excited about this. So don't waste your time. So show it to real CPAs that already know you, already trust you, but don't be thinking you're going to be approached. It's a waste of time to be doing that. Does that make sense, everybody? Can I get some yays or nays? Good. So thank you very much, John. Thanks, Jerry, for bringing this idea to us. Guys, is this okay to bring these kind of things? Yeah, Nick, absolutely bring it to your CPAs. Absolutely. Good. So, and again, we like to do these every 4 to 6 weeks, bring maybe some sort of a product or idea to this. And we like to do something that other people are not talking about. And I like earlier, John, you said this is basically a CRT light. So much easier than trying to put a CRT together. Because I would never do a CRT, but I would do this all day long.
Yep.
Super. Thanks, guys. Go ahead. Sorry.
I was just saying we're happy to do all the heavy lifting too, and make sure we got all the talking points and all that stuff. So yeah, we're here for you.
So you do have talking points, and if you want to reach out and want those talking points, yeah, reach out to John or I think it's Jim, isn't it? And they'll be happy to help you out.
All right. Thank you guys so much
for taking the time, John.
Appreciate it, guys.
Have a great week, guys. Talk to you.